Imagine stepping up to your quarterly earnings call and just casually dropping the fact that you slashed the operating cost of your most advanced, like bleeding edge product feature by over 90%.
Right, just completely out of nowhere.
Yeah, and not by, conducting massive layoffs or degrading the user experience, but by basically ripping out the entire artificial intelligence brain that runs the platform and hot swapping it with a cheaper engine.
Well, a car is still like flying down the highway at 100 miles an hour.
Exactly. It's wild. So welcome to another deep dive here on Talk Tickers. Today, we are tearing into the Q2 2026 earnings call of Duolingo, ticker symbol DUOL.
And, seeing how they pulled off what might honestly be the most impressive tech magic trick of the year.
Yeah, that's the goal. Our mission today is to cut through all the standard Wall Street earnings jargon. We want to figure out if the underlying machinery of this language learning giant actually justifies its current valuation.
Or, if its growth story is maybe masking some serious structural cracks, right? Because investing in a freemium tech company is, well, it's a lot like building a Duolingo learning streak.
Oh, that's a good way to put it.
Right.
It requires daily compounding discipline.
Totally. You can't just set it and forget it. And today we're looking under the hood to see if management is maintaining their streak or if they need a streak revival of their own.
Right. So let's start by throwing the critical data points right on the table. We need a firm map of the territory we're analyzing. When you look at the Q2 headline numbers, the daily active users, the DAUs, they grew 23% year over year.
Which is just a massive number at their scale.
It is. And that's not just a solid number. It actually represents an acceleration from Q1. In the attention economy of 2026, consumer tech companies are fighting tooth and nail just to maintain flat engagement.
Yeah, just treading water is considered a win right now.
Exactly. So getting a user base of this sheer magnitude to compound at an accelerating rate is, it's pretty crazy. Then you glance over at the balance sheet, and it is an absolute fortress. They're sitting on $1.3 billion in cash.
Just an incredible war chest.
Right. They generated $79 million in free cash flow in this quarter alone, and they actively put that money to use, repurchasing about $44 million of stock in Q2.
Which, if I remember right, brings their cumulative repurchases to roughly 72 million, right?
Yeah, effectively taking about 700,000 shares completely off the table.
So the translation of those numbers is really what makes this dynamic so compelling. The top line revenue landed exactly where consensus estimates expected it to be, but the profitability metrics, they significantly outpaced the internal models.
It was a massive beat on the bottom line.
Exactly. In financial parlance, we are looking at a classic beat and raise scenario focused entirely on profitability. The user adoption is scaling, but crucially, it isn't, dragging down their unit economics.
But, okay, I'm looking at this 23% DAU acceleration, and my immediate instinct as an investor is that bookings should be ripping higher at the exact same time.
Right. You'd think there would be a direct one-to-one correlation.
Yeah. If you have that many more people pouring into the app every single day, why is management stubbornly holding the line at an expected 10 to 12% bookings growth for the year?
It's a really valid question.
I'm actually borrowing a point here from one of the analysts on the call, Wyatt Swanson. He essentially asked why a flood of new users doesn't translate to a flood of new cash immediately.
Because it feels like they're just leaving money on the table, right?
Yeah, exactly. In a quarter where they easily could have squeezed those new users for a massive revenue beat, they just didn't.
Well, that assumption relies on treating a freemium consumer app like a traditional enterprise SaaS model, where a new deployment equals a new invoice on day one.
Right, which it obviously isn't.
No, not at all. We have to analyze the specific mechanics of what I call the freemium lag. Free users on a platform like this, they just do not monetize the moment they download the app.
They need time to get hooked.
Exactly. There's a deeply ingrained psychological timeline at play here. A user has to engage with the free tier long enough to establish a daily habit.
Like brushing your teeth.
Right. And then slowly, the friction of that free tier, the unskippable ads, the limited health, or the energy mechanics, it has to become so irritating that it finally outweighs the perceived cost of upgrading to the premium tier.
So it's basically a war of attrition between the user's patience and the product's friction.
That is precisely what it is. Management has drawn a very specific, premeditated box that they are operating within. They've decided that 10 to 12% bookings growth is like the optimal speed limit.
Interesting. So they're deliberately restraining short-term monetization.
Yes, to ruthlessly protect their overarching mandate, which is reaching 100 million daily active users by 2028.
Wow, 100 million daily.
Yeah. If they cranked up the ad load tomorrow or, made the free tier incredibly punitive, bookings would absolutely spike for Q3.
And Wall Street would probably throw a parade for exactly 1 quarter.
Right, a massive parade. But then the top of funnel growth would flatline immediately, churn would explode, and the long-term compounding network effects would be just completely destroyed.
So they are actively choosing market share and terminal velocity over quarterly vanity metrics.
Exactly.
It requires an immense amount of discipline to look Wall Street in the eye and say, we know we could make more money today, but we aren't going to.
It's a rare trait in public markets.
It really is. They recognize that a user base of 100 million people opening an app daily is basically a geopolitical level asset. And the monetization levers available at that scale are vastly more powerful than whatever they could squeeze out of a 20 million user base today.
Absolutely. But to achieve that, you have to actually retain the people coming in the door.
Right. Which brings us to the next point. The DAU growth of 23% wasn't just driven by new marketing. Management pointed heavily to a phenomenon they called the green machine.
Yes, the green machine.
And this was massively accelerated by a specific campaign in June called the Streak Revival.
Oh, the metrics stemming from that June campaign are just staggering. Over 15 million learners successfully revived their streaks in that single event.
15 million. That's the population of a small country.
Right. And as a direct result, their current user retention rate, or TUR, hit an all-time high. It climbed a full percentage point over the trailing 12 months.
Moving a retention metric by a full 100 basis points for a user base of this size, mathematically, that changes the entire compounding trajectory of the business.
It really does.
I want to break down the behavioral psychology behind that Streak Revival campaign, though, because I feel like it addresses the darkest side of their own gamification strategy.
For sure. The streak is a double-edged sword.
Right. The daily streak is the engine of their engagement, but it is also their biggest churn vulnerability. Like when a user has a 200-day streak and they miss a single day because they were traveling or they were sick, the psychological blow is devastating.
They feel like they failed.
Yeah, they do. Yeah. The streak transforms from a motivator into this albatross of shame. And instead of starting over at day 1, they just uninstall the app to avoid the negative emotion.
It's basically the sunk cost fallacy inverted.
Oh, that's interesting. Explain that.
Well, the investment of time was so high that losing the streak feels like losing a piece of their digital identity.
Yeah.
Management realized that their own core mechanic was pushing their most dedicated users out the door the moment human error occurred.
So they essentially issued a blanket forgiveness pass. The campaign offered to magically restore that lost streak if the user simply completed 3 lessons.
Right, a very low bar for entry.
It makes me think of the gym industry. The hardest part of going to the gym isn't the workout. It's walking through the front door after you've skipped 2 weeks because you feel that underlying guilt.
Oh, absolutely. The shame keeps you away.
Exactly. By offering this revival, they completely removed the friction of shame. And the most compelling data point management highlighted was that the cohorts who participated in this streak revival are actually retaining at a higher rate than the standard re-engaged user.
Which is wild. But that data point validates the psychological thesis. When you return a sense of lost identity to a consumer, they guard it with even more ferocity.
They realize how fragile it is.
Right, so their daily compliance actually goes up. But it's vital to understand that the retention numbers aren't just the result of a one-off June campaign.
Right, it's not a silver bullet.
No, the green machine is a broader structural reality. The CEO explicitly discussed their A/B testing infrastructure. He noted they're shipping roughly 350 user experiments every single week.
Okay, I read that 350 number, and I honestly thought it was a typo in the transcript. Shipping 350 distinct product permutations into a live, globally scaled app every week sounds like a recipe for absolute engineering chaos.
If handled poorly, it absolutely would be. But they've built a testing harness that allows for microscopic, highly isolated iterations.
Give me an example of what that looks like.
We are talking about minute adjustments to notification cadences, the specific color grading of a button, or the exact phrasing of a push notification in 40 different languages.
Just tiny incremental tweaks.
Exactly. And the CEO pointed out that their velocity of experimentation is actually outpacing their headcount growth.
Wow, so the tooling is getting better.
Right. The efficiency of their engineering teams to deploy, measure, and validate these microtests is basically the unseen moat of the company.
Because a 0.1% improvement in lesson completion might seem statistically irrelevant on its own.
Oh, completely irrelevant in isolation.
But when you stack dozens of those improvements week after week, you arrive at that record high retention rate.
Exactly. The compounding effect is massive.
Which forces the next logical question, right? Once you have engineered this ultra sticky, hyper-retained user base, how do you actually extract capital from them without reversing all that psychological goodwill?
And that brings us to their pricing architecture.
Right. Specifically, the shift in their trial strategy and the testing of this new super light tier. Their monetization team's mandate seems to be finding revenue streams that are fundamentally decoupled from user friction.
Historically, pushing a user to a paid tier meant making the free tier more painful. You add more ads, you throttle their progress, you limit their lives.
You annoy them into paying.
Exactly. But this quarter, we are seeing a deliberate pivot away from that philosophy.
The most aggressive move here is abandoning the standard 7-day free trial for their premium super tier and offering a full 1-month free trial instead.
Which is a huge shift.
Yeah. And my immediate reaction, putting on a traditional analyst hat, is that giving away 30 days of your premium product is going to completely cannibalize your short-term revenue.
You think so, right?
Yeah. You are opening the door for massive trial surfing, where users just binge the content for a month, brine out on their initial motivation, and churn before their credit card is ever charged.
Well, the fear of trial surfing is totally valid in traditional subscription models, like Netflix. But language acquisition doesn't follow the binge mechanics of a streaming service.
Because you can't binge learn Japanese in 30 days.
Exactly. You just can't. What you can do in 30 days, however, is establish an unbreakable habit loop.
Okay, that makes sense.
A 7-day trial keeps a user on guard. They know it's temporary, so they don't fully integrate the premium features into their daily routine.
They might even avoid using it heavily because they know they'll lose it by the weekend.
Right. But a 30-day trial fundamentally alters the user's baseline expectation of the software.
They get completely accustomed to the absolute lack of friction. No ads interrupting their flow, unlimited attempts at hard lessons, personalized practice.
Correct. So when day 31 arrives and they are suddenly dropped back into the free tier, the whiplash is severe.
I can imagine.
The cognitive dissonance of suddenly seeing ads again and having their progress halted by energy limits makes the free tier feel entirely unacceptable.
So it's basically a much more effective psychological trap.
Yeah, pretty much. The internal data clearly shows that the conversion rates from a 30-day trial vastly outperform the 7-day model, even factoring in the deferred revenue of that first free month.
And while they are in that 30-day window, their engagement metrics probably spike, contributing positively to the overall DAU momentum.
Exactly. It's a win-win for their core metrics.
But they're also targeting the segment of the market that simply will never convert to a standard premium tier, regardless of how good the 30-day trial is.
Right, the price-sensitive cohort.
Yeah. They are quietly rolling out tests for a tier they call super light. And the mechanics of this are fascinating to me. They're pricing it at roughly half the cost of the main super tier.
Okay.
But instead of just giving a stripped-down version of premium, they are keeping the ads turned on and simply doubling the user's daily energy limits rather than making them unlimited.
It is an exercise in meticulous price segmentation. You have a massive cohort of highly engaged, price-sensitive users.
Right, maybe younger demographics or users in emerging markets.
Exactly. Users who will never justify the $12 or $15 a month for the full premium experience. By offering a $6 or $7 alternative, you capture that latent willingness to pay.
And the genius of keeping the ads turned on for the late tier is that they are double dipping.
Oh, absolutely.
They secure a recurring subscription revenue stream, however small, while simultaneously preserving their ad inventory. They aren't cannibalizing their ad network to get that subscription.
Right. They are just relieving the most acute pain point, the energy limits, while keeping the user firmly inside the monetization machine.
Which is brilliant. But the CEO was extremely cautious to frame this as early-stage testing, right?
Oh, yeah. They're terrified of accidental cannibalization.
Right, full-price super subscribers trading down to light just to save money.
Exactly. But if their data science teams can perfectly thread the needle, identifying and targeting only the users with zero probability of buying the full tier, Superlight could represent hundreds of millions in net new, highly profitable revenue over the next few years.
Wow. Hundreds of millions just sitting there.
Yeah.
But speaking of profitability, we have to transition into the absolute centerpiece of this earnings call.
Yes, the AI cost revolution.
This was the moment that made me sit up and literally reread the transcript. Every single tech company on the planet is currently shouting about their AI integration, but almost all of them are quietly bleeding cash to run those models.
Compute costs are just destroying gross margins across the sector right now.
Exactly. But management revealed that the operating cost of their flagship generative AI feature, the AI video call, has plummeted from 30 cents per session to under a single cent.
It's an unbelievable drop.
A 90+% cost reduction on a computationally intensive generative AI workload. My first thought was that they must have built their own proprietary foundational model from scratch, but that makes zero economic sense for a consumer app.
No, none at all.
So how are they actually achieving a sub-penny inference cost?
Well, they executed a ruthless and just brilliant architectural pivot. When they initially launched the AI video call, which, allows users to have unscripted, dynamic, spoken conversations with an AI persona.
Right, it's a super cool feature.
It is. But they relied heavily on proprietary frontier models at first. We are talking about the massive trillion-parameter behemoths like OpenAI's GPT-4.
Which are notoriously expensive to run.
Incredibly expensive. Running real-time, low-latency voice inference on a model of that size requires an astronomical amount of compute. At 30 cents a call, it was financially ruinous.
And that's why they originally gated the feature behind their absolute highest, most expensive subscription tier.
Yeah.
Max, right? They had to charge a massive premium just to avoid losing money every time a user tapped the call button.
Right. But management recognized that the trajectory of open source and open weight models was accelerating much faster than anyone anticipated.
Faster than the proprietary models, you mean?
In terms of efficiency, yes. So they shifted the workload away from the expensive frontier APIs and began utilizing highly optimized, smaller open weight models.
That they could run much more efficiently.
Exactly. Either self-hosted or via significantly cheaper compute providers.
Louis van Aan, the CEO, had a quote that perfectly encapsulated their philosophy here. He basically pointed out that if you have a user who only knows 100 words of Spanish, you do not need to connect them to an artificial intelligence that has ingested the entire sum of human knowledge and can debate existential philosophy.
Right. They don't need a supercomputer.
No. The user just needs to practice ordering a coffee and a croissant.
It highlights the massive inefficiency of how most companies are deploying AI right now.
Yeah, how so?
Using a frontier model to simulate a barista for a beginner language learner is like using a Ferrari to drive to the end of your driveway to check the mail.
That is a perfect analogy.
It works, but the cost profile is absurd. By routing these specific narrow-scope conversational tasks to smaller, purpose-built open-source models, they maintained the exact same user experience while completely collapsing the cost of goods sold.
And the latency is often even better, right?
Yeah.
Because the smaller models require less compute time to generate the next token of speech.
Exactly. It's faster and cheaper.
And the ripple effect of that cost collapse is what changes the product strategy entirely. Because it now costs under a penny to facilitate these calls, they are ripping the feature out of the hyper-expensive max tier and rolling it out to all new subscribers of their standard super tier.
They are democratizing their most advanced feature because they can finally afford to.
But this introduces a massive strategic dilemma, which one of the analysts pressed them on. If the standard super tier gets the AI video call, what is the point of the max tier? Doesn't the highest priced offering instantly become obsolete?
Yeah, the cannibalization of your own premium tiers is a very delicate tightrope.
How did the CEO respond to that?
He was surprisingly transparent, admitting that the internal product teams are still debating the ultimate fate of Max.
Yeah.
He outlined two highly probable paths.
Okay, what's the first one?
The first is a classic metering strategy. Standard super users might get a hard cap, say, 5 video calls a month, while Max subscribers retain unlimited access, catering to the absolute power users.
And the second option?
The second option is that they sunset the Max tier entirely and fold everything into one unified premium subscription.
Wow. Well, that might seem like throwing away high-margin revenue on the surface. I assume the underlying data dictates the logic there.
It does. The data clearly shows that users who engage with the AI video call spend dramatically more time in the app, they progress faster, and they have a significantly lower churn rate.
So if democratizing the feature increases the average lifetime value of a standard super user by extending their retention by several months,
that aggregate revenue will vastly outstrip the marginal gains of keeping a tiny fraction of users quarantined in the Max tier.
that makes total sense. It all circles back to the North Star metric: retention and daily engagement. If the AI makes the product undeniably sticky, you get it into as many hands as possible.
Exactly.
But the pivot to open source AI models doesn't just solve a margin problem. It accidentally solved an enormous geopolitical expansion problem for them, specifically regarding their second largest daily active user market, China.
Yes, the dynamics of operating a generative AI platform in the Chinese market are incredibly complex.
I can imagine.
You have severe regulatory frameworks managed by the Cyberspace Administration of China, strict data residency laws, and rigorous censorship requirements. From a purely legal standpoint, deploying a US-based frontier model like OpenAI or Anthropic within a consumer app in China is a non-starter.
Right. So if their entire tech stack was hard-coded to rely on OpenAI APIs, their flagship AI features would be completely locked out of their fastest-growing market.
Exactly. They would hit a regulatory wall.
But because they built the internal routing infrastructure to seamlessly hot swap the brain of the AI from a frontier model to an open source model to save costs, they can use that exact same abstraction layer to swap in a locally approved, state-compliant Chinese AI model for their users in China.
It turns what could have been a catastrophic regulatory blockade into a simple plug-and-play engineering task.
That is just incredibly lucky or brilliant foresight, or both.
Yeah.
And that agility is paramount because management expects China to surpass all other regions and become their absolute largest DAU market globally within the next 12 to 24 months.
Which is huge. Furthermore, they noted that the monetization profile of the Chinese user base is surprisingly robust, currently monetizing at a rate comparable to mature European markets like France.
Wow, really? To fuel that specific regional growth, they are completely overhauling their customer acquisition strategy over there.
Yeah, they have to.
Historically, this is a company that prided itself on organic word-of-mouth growth. When they did step into marketing, it was mostly through owning their own bizarre, slightly unhinged social media presence.
The threatening green owl on TikTok is practically a cultural phenomenon.
It really is. But in Asia, they are deploying highly localized influencer marketing at massive scale.
Well, performance marketing and traditional digital ad buys just have fundamentally different conversion mechanics in markets like China, Indonesia, and India, where super apps dominate the ecosystem.
So the standard playbook doesn't work.
Right. They realized that standard ad inventory wasn't penetrating, so they pivoted. Currently, 2/3 of their social media impressions in these key Asian markets are generated not by their own corporate accounts, but by localized influencer networks.
It's a localized trust transfer. Instead of an American brand shouting into the void, they are leveraging regional creators to contextualize the app's value proposition within the local culture.
Exactly.
It bypasses ad blockers, feels organic, and clearly, based on the 23% DAU growth, it is converting at a phenomenal rate.
The strategy is undeniably working.
But while we are on the topic of understanding specific demographics, we have to talk about the Math app, because this was easily the most refreshing, brutally honest moment of the entire earnings call.
It is so rare to hear a tech CEO publicly admit a fundamental flaw in their core product philosophy.
Oh, totally. So for context for you listening, the platform has expanded beyond just languages over the last year. They integrated a music course and a math course directly into the primary application. The initial thesis from the CEO was that the gamified mechanics that make learning Spanish fun could be seamlessly applied to adult numeracy. Like, he envisioned the average 35-year-old professional casually brushing up on fractions and algebra during their morning commute.
And he stated, point blank on the call, "I was wrong. I don't believe we can do that."
I found that fascinating from a cognitive science perspective. Language acquisition is inherently social and communicative, right?
Yeah.
Even practicing basic phrases feels connected to human interaction.
Absolutely.
But mathematics, especially for an adult who is out of the educational system, is abstract, solitary, and often heavily associated with childhood academic trauma.
Yeah, a lot of people just hate math.
Exactly. You can put all the dancing owls you want on the screen, but if a 35-year-old hates long division, they simply are not going to engage with it recreationally.
It is the ultimate lesson in recognizing the limits of product market fit. You cannot engineer consumer desire where absolutely none exists.
So what are they doing instead?
Well, rather than pouring more capital into a flawed thesis, they executed a hard pivot. The product roadmap for the math application has officially been redirected to focus squarely on the K-12 student demographic.
The people who actually have a mandatory extrinsic motivation to learn the material, they need to pass their classes.
Right.
The CEO noted that the moment they made this internal mental shift, accepting that their core user is an 11-year-old struggling with homework, not a 35-year-old optimizing their brain, the product development pathway became instantly clear.
It simplifies everything.
Right. They aren't shifting to a B2B model. They aren't trying to sell enterprise contracts to school districts, which is a notoriously brutal sales cycle.
No, they're keeping it direct to consumer.
Exactly. But tailoring the user experience, the progression curve, and the feedback loops specifically to supplement a child's academic curriculum.
Which is smart because it shrinks the total addressable market from every adult on Earth to a specific subset of students. But a smaller market with intense immediate demand is infinitely more valuable than a massive market with zero interest.
Absolutely. And this level of pragmatic resource allocation segues perfectly into their forward-looking financials.
Let's get into the numbers.
Let's break down the management guidance to understand exactly how Wall Street is going to model the back half of the year. For Q3, they are targeting bookings of roughly $307 million, which represents a 9% year-over-year growth.
Okay.
Revenues projected at $302 million, signaling 11% growth. They expect gross margins to hold strong at 71% and adjusted EBITDA to land around $76 million, translating to a 25.2% margin.
But the real narrative lies in their full year 2026 revisions.
Yeah, walk us through those.
They're projecting full year bookings growth of approximately 11%, with revenue growth trailing slightly higher at roughly 16%. They anticipate generating over $375 million in free cash flow for the year.
Which is incredibly healthy.
It is. However, the most critical data point for investors modeling this stock is the upward revision of their margin outlook.
Right, because they raised their full year adjusted EBITDA margin expectation to 25.5%, up from the 25% they guided toward at the beginning of the year.
Exactly.
Simultaneously, they expect gross margins to settle closer to 70%, an upgrade from their initial 69% target.
Now, in isolation, a 50 basis point increase in EBITDA margin might seem like a minor mechanical adjustment.
A rounding error to some.
Right. But context is everything here. You have to evaluate that margin expansion against the backdrop of their operational behavior.
Yeah.
They are actively, aggressively rolling out highly complex, computationally heavy generative AI features to millions of new users.
Right. The historical precedent over the last 24 months of the AI boom is that when a software company integrates generative features, their gross margins take a severe beating.
The compute costs drag down the entire profitability profile.
Exactly.
But they are deploying AI at scale while simultaneously raising their profitability guidance. It is an extraordinary flex of operational efficiency.
It really is.
It definitively proves that their strategic pivot to open weight models wasn't just a theoretical cost-saving exercise. It is generating massive structural leverage that is dropping straight to the bottom line.
So the unit economics of the business are actually improving as the product becomes more advanced.
Exactly. It completely insulates them from the API pricing volatility that their competitors are exposed to.
Now, while analysts were crunching those margin numbers, there was a very peculiar detail buried at the very end of the CFO's prepared remarks.
Oh, the Easter egg.
Yeah, it was a highly specific, conditional piece of information that felt like a deliberate signal for the institutional investors listening closely.
You're talking about the structural conditional bonus plan.
Yes, the bonus plan. The CFO outlined a specialized $10 million cash bonus pool earmarked for the executive and core teams, payable in Q1 2027.
Okay.
But it is entirely contingent on one single binary metric. Q4 daily active user growth must hit 25% or higher. If it hits 24.9%, the pool is zero. If it hits 25%, $10 million unlocks.
The signaling mechanics of this are just fascinating. Corporate compensation plans are tweaked constantly, but a CFO rarely broadcasts a highly specific binary internal target on a public earnings call.
Especially when she explicitly noted that this $10 million expense is not factored into their official Q4 margin guidance because they cannot guarantee it will trigger.
Right. So why broadcast it then?
My read is that it's a flare shot directly at the short sellers and the skeptical analysts. By dangling this very public carrot, management is broadcasting supreme confidence in their product pipeline for the back half of the year.
I agree completely.
You don't set a 25% DAU growth target for the fourth quarter, which requires them to actually accelerate beyond the impressive 23% they just posted, unless you have significant unreleased product features or marketing campaigns chambered and ready to fire.
It also demonstrates profound internal alignment. In many publicly traded tech companies, executive compensation is tied to nebulous adjusted EBITDA targets or short-term revenue thresholds,
which incentivizes management to slash R&D and squeeze users just to hit their quarterly numbers.
Exactly. By tying a massive cash payout exclusively to top-of-funnel user growth, the board is forcing the entire management team to stay hyper-focused on the long-term moat of the business.
They are essentially saying, do whatever it takes to capture market share, build the network, and the cash will follow. It's an incredibly aggressive posture.
It is.
So taking all of this into account, the DAU acceleration, the pricing segmentation, the AI cost collapse, and the margin expansion we have to synthesize this into a final verdict.
Okay, the bottom line.
Yeah. If I am a retail investor looking at my portfolio right now, is this earnings call a definitive bullish or bearish signal?
The synthesis of these data points leads to a definitively bullish conclusion. If you are currently holding a position, the fundamental thesis of your investment is materially stronger today than it was a quarter ago.
The operational discipline is really what stands out to me. They aren't chasing the shiny objects of the tech world. They are executing a methodical, compounding strategy. But beyond the current execution, there is a massive catalyst sitting in plain sight that we haven't even fully explored yet. And it involves how they are restructuring their monetization engine.
Ah, you were referring to the overhaul of the advertising unit.
Yes, the ads.
Yeah.
Through the Q&A, the CEO was remarkably candid about their historical negligence regarding ad revenue. He admitted that just a couple of years ago, their entire internal investment into monetizing the massive free user base via advertisements consisted of half a person.
Literally half a person.
Literally one employee spending 50% of their time managing the ad stack.
Well, it reflects their historical DNA. They viewed themselves strictly as a premium subscription business. The free tier was just a chaotic top-of-funnel mechanism, and the ads were merely a necessary friction point to drive upgrades, not a primary revenue stream.
But the scale has shifted, right? When you are approaching 100 million people opening the app every single day, you cannot leave that ad inventory unoptimized.
No, it's financial malpractice.
Exactly. They announced they have completely abandoned the half-a-person approach and have built a dedicated, highly professional ad sales and ad tech unit.
Which is a huge structural upgrade.
They are fundamentally overhauling their ad-serving architecture to improve the quality of the placements, target demographics more accurately, and most importantly, drive up their CPMs, the revenue generated per 1,000 impressions.
The financial implications of optimizing a daily ad network of that magnitude are profound. Because the fixed costs of the platform are already covered by the subscription business, any incremental revenue generated from improved ad CPMs flows almost entirely to the bottom line.
It's pure profit.
Basically, yeah. When you combine an optimized professional ad network with the structural margin expansion we discussed regarding the open source AI models, the long-term cash flow generation profile of this company becomes exceptionally robust.
We do have to flip the coin, though. No thesis is bulletproof. What is the bear case here? What is the specific risk vector that an investor needs to actively monitor?
The primary risk isn't necessarily internal execution, the balance sheet, or even competitor product launches. The greatest risk vector is the psychology of Wall Street itself.
Okay, explain how that manifests for the stock price.
It circles back to the very first point we discussed, the freemium lag and management's refusal to accelerate short-term monetization.
Right, the 10 to 12% growth limit.
Exactly. The core operating philosophy of this company is to prioritize terminal DAU scale, that 100 million goal by 2028, over immediate revenue extraction. As a direct result, their top-line bookings growth is likely going to remain anchored in the low double digits, hovering around that 11 to 12% mark for the foreseeable future.
Which is perfectly healthy for a sustainable business, but it absolutely fails to satisfy the hypergrowth momentum traders who want to see SaaS-level 30% revenue compounding quarter over quarter.
Precisely. The risk is an alignment mismatch between management's timeline and the market's patience.
So if the vibe shifts.
Right. If the macroeconomic environment shifts, perhaps interest rates rise again, or there is a broader contraction in tech multiples, institutional investors might suddenly demand immediate cash flow realization from all those free users.
They won't want to wait for the freemium lag.
Exactly. If Wall Street decides they no longer want to wait for the freemium lag to play out, the stock could experience severe, violent multiple compression, even if the underlying business metrics remain pristine. The market could punish the stock severely simply because management refuses to squeeze the lemon today.
So the actionable advice here is essentially a test of temperament. If you are an investor who requires instant gratification and linear aggressive quarterly revenue beats, this stock will likely cause you massive anxiety.
It's not a fast money play.
No. You have to be philosophically aligned with delayed gratification. You have to trust that the compounding nature of their experimentation engine, their record high retention rates, and their massive cost advantages in AI inference will eventually translate into an insurmountable global moat.
Right. If you believe that capturing a sliver of daily attention from 100 million human beings across the globe is the ultimate underlying asset, then the runway for capital appreciation here is remarkably long.
It is a masterclass in delayed gratification. And as we map out all these strategic chess pieces they are moving, it leaves me with one final, slightly provocative thought to chew on.
Let's hear it.
Look at the architecture they are actively building. They are introducing ad-supported light tiers to segment and capture highly specific price-sensitive demographics.
Yep.
They are rapidly upgrading their internal ad tech from a single part-time employee to a sophisticated global ad sales network designed to maximize CPMs.
True.
They have engineered an AI infrastructure so agile that it can hyper-localize and comply with complex foreign regulatory environments like China. And they are deploying localized influencer networks at a scale that resembles a massive media operation.
It sounds less like an education startup and more like the foundational infrastructure for a global media conglomerate.
That is exactly the thesis.
Yeah.
Are we sitting here analyzing a language learning application?
Yeah.
Or are we watching the slow, methodical construction of a massive AI-driven global media and advertising network?
Wow.
A network where education and gamified daily streaks are simply the top-of-funnel hook required to capture your attention for 5 minutes every single day.
It fundamentally reframes the valuation model. When you control the daily habitual attention of 100 million people, the categorization of your company shifts entirely.
You transition from an ed tech utility into an owner of a massive, highly engaged slice of global human bandwidth.
Exactly. And how they ultimately choose to monetize that bandwidth over the next decade is the real story.
And exploring that evolution is a deep dive for another day. Thank you for tuning into this analysis. As always, analyzing these markets requires patience, a tolerance for complexity, and the discipline to look past the immediate headline numbers.
Keep interrogating the beta.
Yes, ignore the short-term noise, and whatever you do, keep your unlearning streaks alive until our next deep dive.